The equity awards that companies grant to their employees are a form of compensation. And as compensation, those awards should result in an expense that the company records in its income statement and that ultimately reduces the profitability of the company. But unlike cash compensation, when we're talking about equity, it's a little hard to figure out what that expense should be. Let's say that a company grants an option to purchase 5,000 shares to an employee. What did it really cost the company to grant that option? Did it cost them anything? What happens if the option expires unexercised and the company gets the shares back? Then did it cost the company anything? In this video, I'm going to cover 3 key concepts that govern how companies record expense for equity compensation. The concepts that I'm going to cover are all part of US GAAP. GAAP stands for Generally Accepted Accounting Principles, and these principles govern really how companies account for everything. How they account for their revenue, their expenses, their assets, their liabilities, shareholders' equity, everything having to do with the business is covered under US GAAP. We're going to be talking about a very specific part of GAAP called Accounting Standards Codification number 718. Or ASC 718, as it's known to its friends. This is the accounting standard that applies specifically to stock compensation. Under ASC 718, there are 3 key concepts we need to understand. The first is the measurement date. The second is the amount of expense that needs to be recognized for an award. And the third is the period that that expense needs to be recognized over. Let's start with the measurement date. The measurement date is just a point in time that the company will calculate the amount of expense that it needs to recognize for an award. For awards that are settled in stock, the measurement date is usually the grant date. And for awards that are settled in cash, the measurement date is usually the settlement date. Once we have determined our measurement date, then the next step is to determine the amount of expense the company needs to recognize. Under ASC 718, the company recognizes an expense equal to the fair value of the arrangement. The fair value is just the amount a willing buyer would pay a willing seller to acquire that arrangement. For full value awards like restricted stock and units, the expense is pretty easy to determine because those arrangements provide stock to employees. So the fair value of the arrangement is just the value of the stock that employees will receive under it. For an arrangement like a stock option or a stock appreciation right, the fair value is a little bit trickier to determine. Even if we are a publicly traded company and we have options that are traded in our stock out on the open market, those options likely look very, very different than the options that we grant to our employees. So we can't use the value of those traded options to determine the fair value of the options we grant to our employees. Instead, we will use a formula called an option pricing model. The most common formula to use is the Black-Scholes model. You might have heard of it, actually, because this is actually a pretty well-known formula. And in fact, the developers of the formula won the Nobel Prize for developing it. Lastly, let's talk about performance awards. For performance awards, the fair value will depend upon the conditions that the award is subject to. If vesting in the award is contingent on market conditions, so a market condition would be something like a stock price target, a total shareholder return target, or a target related to the market capitalization of the company. When those types of targets are used, the company has to use another option pricing model to determine the fair value of the award. In this situation, the model that most companies use is something that's called the Monte Carlo simulation. If our performance awards are not subject to market conditions, in that case, the fair value of the award is just the value of the underlying stock. Once we've determined the amount of expense the company needs to recognize, the next thing to determine is the period over which that expense has to be recognized. The company will not recognize that expense all at once as soon as it determines it. Instead, under US GAAP, there's something called the matching principle. And what this principle says is that companies should recognize expenses as those expenses produce revenue for the company. In the context of equity awards, the awards are producing revenue as employees perform the services necessary to earn those awards. So we will recognize expense over the period that employees are performing those services. Well, that's generally defined as the vesting period. That's the rate at which employees are earning the awards for the services that they are performing. So once we've determined our expense, we will take that total expense and we will spread it out over the period that the award is vesting, and we will recognize that expense in increments over that vesting period. There is obviously a whole lot more to know about how to account for equity awards, but I hope that by watching this video, you feel like you know at least a little bit more about it than you did before. I can't get into all these other concepts in this video today, but the NASPP has lots of resources that help you understand some of these other concepts, and we will post links to some of those resources when we post the video to YouTube. I hope you enjoyed my video today. If you did, please subscribe to our YouTube channel so that you are notified when we post new videos. Heck, you know what? Even if you didn't enjoy it, subscribe anyway. Maybe you'll like the next one. Thanks for watching.